Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is IWM. That is the ETF that tracks the Russell 2000 index. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest, who's filling in for Lindsay Bell this week.
Well, Callie, we have an exciting week. Not only do we have our own digital conference, it's going to be on the Ally Invest YouTube channel, kicking off tomorrow. If you're interested, the registration link should be in the chat box. But we also have a big down day in the S&P 500 index. What do you see happening in the markets this week?
Yeah, Brian. Well, first off, I'm so excited for our digital conference. But you're right, stocks are down for their sixth day in a row, Brian. The S&P is off about 0.5% today after dropping as much as 1.5% earlier today in trading. There aren't any big headlines out there, but there is some pretty palpable worry. There's a mood of worry in the market. I mean, first of all, it's the anniversary of the 2020 market top. So there's a little bit of deja vu feeling out there. I feel it a little bit too. There's also a worry that higher yields could be hinting to more inflation ahead, and more inflation could cause the Fed to maybe cut some of its support from the markets. It doesn't seem to be a sell all my stocks and go into hiding type of sell off, which is actually really encouraging. It's more like people are kind of selling the high growth, high flying stocks, the stocks that have worked so far. And that selling seems to be dragging down the rest of the market. So that's a good sign. Not if you're a tech investor, but it's a good sign for the market overall. Tech stocks and some of the hot stocks like Tesla and Peloton are down quite a bit in the last week or so. So we'll definitely watch that. But overall, the market is holding pretty strong for some of its biggest winners being down so much. And I don't want to overstate the selling either, Brian. Stocks may be down for a sixth straight day, but the S&P 500 through yesterday has only dropped about 2% or 1.5%. That's the smallest 5-day losing streak since 2016, Brian. So that's a fun fact you can mention during your next Zoom happy hour. So stocks overall are kind of teetering on the brink of what could be something more. And to be fair, the stock market is looking pretty primed for a bigger drop. Nothing too crazy. And I don't think you should have deja vu of February 2020 because we don't expect that same market event to happen. But, we could see a 5 to 10% drop to restore some balance and maybe wipe out some extreme emotions in the stock market. By the way, I need to mention that happens in healthy markets with good economic stories. It's not a sign that things are falling apart, and it's nothing to worry about. It's just simply a market reset. And we got some encouraging news this morning when Fed Chair Jerome Powell signaled that the Fed will keep market support high and rates low for a while as the job market heals. So that was encouraging for the stock market too. So looking at other markets, because they seem to be moving more than the stock market these days, I want to point out the 10-year yield. The 10-year yield is down today, which is a big, big change from the fast rally we've seen in yields since, well, pretty much all of this month. We expect yields to keep moving higher. And this is a good thing, by the way. Yields moving higher is typical in an early bull market and an early economic recovery. So I promise it's a good thing. But think long and hard about how this trend could impact your portfolio because it's causing a little bit of angst in the stock market. And it's leading to some sectors selling off more than others. I don't think it's going to derail stocks recovery too much, kind of like what I mentioned earlier. And like I said, big yield rallies tend to happen on early in recoveries. But think about how it'll impact your portfolio holdings and think about the sectors that tend to do well as interest rates rise, like banks, for example, and consumer staples. It's just something to think about as you're picking which stocks to maybe buy or sell as stocks swing around. The US dollar, too, is also near a 3-year low. And remember that because I'm going to mention it in a minute. It's a key part of today's play. So I'm looking at the VIX, Brian, and it seems to be up today, which is no surprise there because stocks are down. So what are you seeing out there?
Well, let me show my little VIX watch list that I have here. And we highlight here on the VIX, we are up above the 25 level. It's taken a little bit to get back to that level, but that was a stubborn level for the VIX to break below for the longest time. But once again, that 20 levels, people still talking about it. It's not in play recently. And going out and looking at the futures in April and May expirations, we still see these futures contracts, which I'm highlighting on my screen right now, up around that 29% level. So this fear in the marketplace is not going away anytime soon. And anytime we get a downturn, it seems like we get a large spike up in the VIX. But whenever we get a nice move to the upside, the VIX just holds steady overall. And a couple other things in the charting world that are probably worth mentioning here. I have a NASDAQ chart that I'm showing right now. And that NASDAQ chart just kind of highlights that we broke through the 50-day moving average, and it's been quite a while since we've done that. Back in early November, you see here that I'm highlighting that we actually did break down below that 50-day moving average. And once we broke above it, it was a strong bull market, obviously, since November. We basically just higher highs, higher lows, all the way up until just recently. So we finally have a bearish looking chart in the NASDAQ for the first time in a long time overall. All the way down here, we're still a little bit extended in general. This is the 200-day moving average, which has really been the case with almost all of the marketplaces, not to mention the IWM, which we're going to look at right now. The IWM is probably the most extended compared to the 200-day moving average out of the major indexes, which obviously is the index that tracks the Russell 2000 index. It's an ETF. And the small caps of the Russell 2000 index have been leading the way most recently on these market highs. So what do you see going on in the Russell going forward?
Yeah, Brian. So small caps are really interesting. And I want to work in a "you're killing me smalls" pun, but I don't think I'll be able to do that. But yeah, small caps. So when we're talking about small caps, we're talking about the smallest stocks traded on exchanges. Their market caps are around 250 million or less, or excuse me, 1 billion or less. I just defined in micro caps, not small caps. But small caps have done really, really well this year. They broke the 50-day moving average in November, but since then, they've really been off to the races, Brian. You know, the Russell 2000, the index that you mentioned a few minutes ago, is up 14% this year. Yes, it's up 14%. Think about that in relation to the S&P 500. I mean, the S&P 500 is up just 3%, which is fine. That's good. But when you compare 14% to 3%, I mean, it just looks all the more impressive. So thinking about it, why are investors all in on small caps? Well, you know, they tend to do better than other parts of the market in economic recoveries. And some small caps have been viewed as speculative plays recently, or, you know, stocks you can take a flyer on. You know, that's all good and well. And to be honest, we're pretty upbeat on small caps over the next few years as the economy continues to strengthen. But in the moment, if we're talking about today, small caps do feel a little stretched. You know, they're typically high growth stocks, which can sell off quicker when the market drops. And there's a dollar aspect to all of this. Remember, I mentioned the dollar earlier? Well, here it is coming back into play. The economy may be recovering, but the US dollar is still near a 3-year low. And that's important for small caps. So if you think about it, what does the dollar have to do with small caps? Well, you know, typically small caps do well when the dollar is rising because they tend to have more US focused revenue, which of course is priced in US dollars. But the dollar has been falling lately relative to other currencies for a few different reasons, namely strong Fed support. And like I said, strong Fed support has helped the stock market overall, but it could weigh on the dollar relative to other currencies, which could end up being a negative thing for small cap revenues and profits. On the flip side, a weaker dollar does equal stronger global business and stronger global stocks. So there's a little bit of a mismatch going on between the rally in small caps and what we're seeing in the US dollar. That makes us a little more skeptical of small caps, especially in the short term. But again, long term, over the next few years, we are bullish on small caps. By the way, we wrote about the US dollar in the most recent weekly viewpoint, so definitely check that out. To sum it all up, Brian, even though small caps could continue to do well over the next few years, they could also be the hardest hit if we see more of a market sell off here. So, to play that, I think you want to be hedged in case small caps fall, but exposed in case small caps rip. So, there's a little bit of a hedge here, but there's also a little bit of a speculative play. So, Brian, I want to get your thoughts on that. But before we do, I want to remind everybody to please drop your questions in the chat because Brian and I will be going through your questions at the end of the show and answering them live. You have questions, and we hopefully have answers for you. All right, Brian, tell us about how to play IWM options.
All right. Well, I'm going to start by highlighting the chart and just kind of highlighting the things that I mentioned, the difference between the NASDAQ and the S&P 500 index, the good old SPX. I actually have the underlying that we're going to talk about today, highlighting it, the IWM. So this is very similar to the Russell 2000 chart in that we see it's a way more overextended relative to the large cap indexes. We see the 200-day moving average all the way down around 167, where we have the actual Russell or IWM index, or ETF, to be more correct, is at 218. So we are a little bit more overextended. Markets in general usually don't go straight up. And we actually had a little bit more chop in the marketplace recently in the IWM, and where we see a little breakdown on the 20-day moving average. Here's the 50-day moving average. We haven't touched that yet. As we broke through in the NASDAQ, we haven't done that in the IWM. So maybe it's a time to think about going short the IWM or also using options to try to maybe protect the small cap part of your portfolio in general. So as always, this is not meant to be a recommendation, but we're going to look at how we might use options as protection and also as speculation today. So we're going to look at a long put spread, and I'm highlighting the long put spread inside the Ally Invest options playbook. Basically, what we're going to do is buy a put, but if we buy that put, that means that we have substantial upside as the market goes down, but it's fairly expensive, and it has to do with where the VIX index is at, where the volatilities in general, the marketplace on stocks and indexes overall have pumped up prices in ETF option contracts, also in individual stock option contracts. So what do we do in that scenario? We want to buy some protection, or maybe we want to speculate on the downside. We're going to buy an option contract and then go down and kind of target a price on the downside and then sell that option contract, hence bringing in some capital and lowering our overall cost of actually putting the trade on, or as you could say, buying that option outright. So long put spread is going to be the theme today. Let's look at the Ally Invest option change. We see the Russell 2000 index is down about 2.5% today. So fairly decent move to the downside, but it's kind of going where the rest of the marketplace is going overall. I'm going to look at the March 19th expiration. Now we have many different expirations to choose from, which I'm highlighting here in the chains. But I'm going to go to about 24 days. So I just want some protection, but I'm not going way out in time. And my idea, if I'm thinking of options as using them for protection, if I wanted to go out longer than 24 days, say I'm thinking 3 months or 4 months, maybe I should just sell it, right? Maybe I should just sell my small cap stocks or sell my IWM if that's the position that I have on, and rebuy it at a later date. That would be my approach to it if I was a little bit more long-term bearish. In this instance, we're just saying that we've had a strong run up, and in the short term, we're more nervous than we are bearish in the Russell 2000 index. It's February, and once again, February is proving to be not a good month for the marketplace. So history is repeating itself a little bit in so far in the markets in general. February is usually not a very good month for the markets overall. And so we're going to stick with that theme. And we're seeing a little bit of a downturn. So how do we participate in this? How do we use this as protection? And maybe I just want to speculate on a downturn move. So we're going to go a little bit out of the money. We're going to try to lower our cost on this. We have right now the Russell 2000 index, let's call it 2018. So we're going to go about 3% out of the money. That means that we're going to buy the 210 strike put. So puts are on the right-hand side of the Ally Invest option chains. So we're going to be buying that, and all I do is click once, and that puts a buy in our little checkbox. That means that's going to be the option that's driving our position. Now, we also want to lower our cost. Now, we're going to speculate on a little bit more of a downturn. I like the 200 range, right, just because it's a nice round number. So we're going to actually sell the 200 strike put. And notice here that we're still getting a ton of premium. As you go further out of the money, a lot of times this is the case on index options that the implied volatilities actually jack up a little bit. There's a lot of people that like to use index options. And in this case, it's an ETF that tracks an index, but they like to use them to protect portfolios. And because of that, you see usually higher implied volatilities the further you go out of the money. So let me highlight that. This is the IV column right here. That's implied volatility. We're going to be buying a 35% implied volatility, and we're going to be selling a 38% implied volatility, which means that we can get this done for a fairly reasonable price, even though we're 10 points wide. So let's look at this concept down below. If I was using this for speculation, we'd be lowering our cost overall of buying the put outright. If we bought the put outright, we're looking at paying right around $4.20, $420 for each one put that we buy. But in this instance, we're going to buy one and sell one. That means our net debit, if we can fill somewhere near the mid price, we'll call it $2.10. That would be $210, and that would be our total risk of this trade plus commission. Always got to add those commissions on. And as always, I have to emphasize, not meant to be a recommendation. We're just looking at how we might use ETFs that track indexes to maybe protect or speculate on a downturn movement. Protect a portfolio against a downturn movement and speculate on a downturn movement. Okay, so now that it's in the right rail, that makes it the official paper trade for this week for the stock play of the day. We're going to be buying one of the March 19th, 2010 expiration, at the same time selling one of the March 19th, 200 strike expiration. Net debit, we were at 210. I'm going to put it at 210. It's 206 right now at the midpoint. We're going to make it 210 just to make the math simple, okay? So never a guarantee of a midpoint fill, but when I'm doing spreads, I'm always going to work. That midpoint is going to be my focus, and I want to try to execute somewhere close to that. But so IWM options have fairly liquid option contracts overall, but still they're not as liquid as the underlying stock. So we're going to try to work the order, try to fill it somewhere around that $210 price. And that means that we have $210 worth of risk plus commission. And our max upside is the width of the spread, which is 10 points, minus $2.10. That means we have $7.90 worth of upside. Okay, now, if I was just speculating on this, that's how I would approach it. I would do a one-by-one paper trade on the IWM and anticipating that this momentum to the downside might continue. Overall, we're only looking at about to go down to, well, right now we said 218. So the math is fairly simple. If it was 220, it would be about a 10% move to the downside to get down to 200. So that's a feasible move over a month period overall. It would be a decent move to the downside, but ideally we don't need it to get all the way down to 200 in order for this trade to be profitable. We just want to break somewhere below that 210 level, that strike that we are buying on this position. Now, if I was thinking about this as a hedge, I need to know, well, how many of these would I do? I have a bunch of miscellaneous small caps in my account. How much portfolio would this protect? And the way to do it is very quick and dirty math is to actually just look at the value of the index. If you have a $218 index, you multiply that by what the contract represents, which is 100 shares, and you have basically $21,800 worth of portfolio protection. Now, ideally, that's not a perfect scenario. It's not going to be a one-to-one scenario, but it gives you a figure if you have 40 some thousand or $50,000 worth of small caps. Well, then I want to buy two put spreads. That's how I want to think about it overall. That's just a simple way. There are other ways to get a little bit more accurate on it, but obviously we just have a half-hour show here. So with that said, that is our official paper trade for the stock play of the day. Let's get to some questions. Callie, do we have any in the chat box?
Yeah, Brian. Well, I'm seeing a few really good ones, but I'm going to go ahead and jump the line because I have a really good question for you to start off with. So thinking about IWM options, Brian, why would you hedge using IWM options instead of options on your individual stocks? What's the benefit in that?
Well, that is a great question, and in reference, I kind of want to go look at what happens in the S&P 500 index. Actually, a lot of people think that option contracts, I think of a lot as speculation, but ideally, especially in the indexes, they're used more often to protect portfolios than to speculate on a move in either to the upside or to the downside. And you can see that just by looking at open interest, the number of contracts that are actually opened. There's a lot more open interest, usually on index options, on out of the money puts comparative to out of the money calls. Why? Because it's a fairly inexpensive way to actually hedge portfolios. If you have a portfolio that kind of acts like these underlyings, you can buy one option contract and represent, in our case, $21,800 worth of portfolio, as opposed to buying multiple option contracts on the small caps that are actually in your portfolio and have to pay for each and every underlying. And on top of it, when you look at the Russell 2000 index and the small caps, option trading isn't easy. Why? Because the markets, those underlying stocks aren't that liquid. And if the stocks aren't that liquid, the options marketplace is going to be a nightmare to execute. So specifically in the IWM, this is a very common thing to do to try to hedge those small cap portfolios by buying either options on the ETF or options on the actual index overall.
Awesome. All right. Well, I just learned a lot, Brian. All right. Let's see if we have any other questions. All right. So I have some good options questions here, Brian. So
All right.
Wayne says, well, hi, Wayne.
Welcome back, Wayne.
Yeah, welcome back.
Yeah, he's here all the time.
Yeah, Wayne's one of our loyal watchers. All right. So, hey, Brian, how would you manage the spread if price goes against us?
All right. Well, in this instance, and this is one of the things, especially because I'm kind of mixing metaphors, I'm talking about it as a speculation tool, and I'm also talking about it as a hedge, as a protection. If it's a protection and it goes against us, and I literally have a portfolio of small caps, well, that's a good thing, right? And this makes option trading tough because a lot of people say, oh, you can lose money trading options. Well, if I did this and the small cap index rises, say I own 100 shares of the IWM and it goes up 20%, and I only lose that $200 for the spread, well, I'm better off, right? Ideally, if I'm using this as a hedge, I want my spread to go out worthless because that means I should be making it on the other side by owning 100 shares of the IWM or my small cap portfolio. So now if I'm using it as a speculation, I would just basically look at it based off of price. I'm going to say that if the market does go down, well, where would I want to get out at? And if I could triple my position, if I paid $1 for it and I could sell it, I'd want to sell it for like $3. And then if I want to manage it, I don't want to just let it ride. I'd say, well, I'm paying $2 for it. If I lose 50%, I want to get out. So I'm looking to double on the correct forecast that the market goes down. And on the opposite side, I'm going to just cut my losses at 50%. That's just a simple thing, a simple math to look at. You got to have your risk parameters, but the biggest thing that you want to do is be consistent whenever you're doing long spreads, long call spreads or long put spreads.
Good answer. All right, Brian. I see a question for me. All right. So
All right.
Yeah. All right. So Naveen asks, do you see further scope for growth in the electric vehicle sector? I'm assuming that's what you mean by EV, the electric vehicle sector and battery makers like QuantumScape in the near future. Oh man, that's a great question. And, honestly, we think about the electric vehicle space a lot, Naveen. It's really interesting, and we think it could be a growing space over time, like over the next 5 years or so. Especially because last month in January, GM, General Motors, announced that it was looking into electric vehicles itself. And it actually plans to offer electric vehicles, all electric vehicles by 2035. So that was almost like a stamp of validity for us, and it's gotten us a lot more interested in the space. It's still a very young space, but I do know if the electric vehicle space grows, it could be good for the battery makers and the suppliers too. And unfortunately, I can't comment on individual stocks, but that's kind of the way that we're thinking about the EV space right now. It's still very young, but at the same time, we are seeing a few stamps of validity that are really encouraging. All
Right.
right.
It's hard to value. I would agree with that. It's just
Yeah.
hard to value exactly where they're at. Are they a car company? Are they a computer company? Are they a battery company? I mean, there's many different facets that it could actually be looked at. So it's a tough space to value, but it's an interesting space to be in.
Yeah, you summed it up perfectly, Brian. It's really tough to value, but it's very interesting. All
Mhm.
right. So I have another options question. Okay,
Great.
Brian. So how do you manage? Okay, James Madsen. I didn't want to forget mentioning your name, James. Hi, James. James asks, how do you manage a trade when the price drops through both of your strikes?
Okay, when it drops through. Okay, I do. A lot of times, if I'm managing trades, there are some particular things that I'm going to be looking at overall. Okay, so if I'm selling a spread, and the market actually drops through my protection, the option that I bought, or somewhere near, I usually want to get out of it. I don't care if it's a 5 point wide spread or a 2 point wide spread or a 10 point wide spread. When the stock becomes, well, when the strike that I'm buying becomes an at the money option contract, I want to capture as much of the time premium as I possibly can. And so I just usually I'm going to close that out. No regard to where the stock is at or whatever, just because of the way options are priced. And that's what this show is all about, talking about option pricing more so than we're talking about our forecast on the underlyings that we're looking at. Now, if it does go through, I mean, and you're losing on that position and then you're losing on it overall, well, you just have to close out the trade. A lot of times if you fall asleep on a trade, I don't have a good answer for how to adjust it. I've had a lot of, to me, if it does blast through your strikes and you're losing on the position overall, it's kind of like asking, well, if I drive a car off the cliff, how do you fix it? It gets tough to do it if you're not watching it as it goes. And that's one of the things about being an option trader. If you're speculating on option trades like this IWM trade, and you're not actually have access to the markets most of the day, it's really tough to do that position. Now, I get, once again, mix and metaphors. If I'm just using it as protection, I'm just going to put it on and let it ride and come back at March 19th expiration and say, hey, am I going to close out this position? Or am I going to roll it into a new position because I'm still nervous about the marketplace? But overall, hedging is much different than speculating as far as watching the markets.
Definitely. Good point, Brian. All right. I'm not seeing many more questions. I do see one from Brad Warren. Maybe we'll wrap up with that one, Brian.
All right.
Yeah. So this is for me. So Brad Warren, hi, Brad. Brad asks, is Bitcoin and other cryptocurrency an effective hedge against a weakening dollar, or is it still too volatile? That's a great question, Brad. And
Are you sure that's not for Janet Yellen?
I know, right? Yeah, lots of talk around crypto these days.
Mhm.
So Bitcoin is definitely used in the marketplace as a hedge for a weakening dollar. That's one of the main uses for Bitcoin. We can't make recommendations either way, but that's definitely one of the primary uses. Honestly, it is still a very young currency and it is very volatile and speculative. And with hedges, you typically want them to be a little more predictable and a little more stable, just so you know that they work when you need them. So that being said, I can't really say if it would be an effective hedge. I think it's just too soon to tell. I can't talk today. But it is good to know that people do use it that way. So I hope that helps. I know that's a little wishy-washy.
Well, and it needs to be a little wishy-washy because there's really nothing solid about Bitcoin. First of all, it's an electronic currency. There's nothing that's really backing it. And then we also saw Powell today, Fed chair, come out and mention that, well, maybe the U.S. wants to make their own digital currency, and that is a possible space. And that's where you're really seeing the weakness in Bitcoin today because of comments like that. There, people are still figuring it out overall, even though it's been around a while. People are still figuring out exactly what it is. And I don't know if we have a great answer for that question yet. And until we do, it's an alternative to maybe things like gold, but it's much more speculative overall because of that.
Mm-hmm. Mm-hmm.
All right.
All right. So you want to squeeze in one more question? Do a little 30-second speed
All
round?
right. It's got to be quick.
All right, we'll do it quick. Okay, John M. Hi, John. So John says, hey, Brian, when looking at vertical spreads like this, do you ever focus on the 80 delta as you do when looking at long-term stock surrogates like FOMO trades?
You're right. Oh, I like so you're using the FOMO situation. So that obviously a longtime listener, because we've mentioned a lot of FOMO trades recently. And in general, no, I don't. Not on this situation because we are speculating on it. I'm looking more so at how far out of the money am I willing to go? So this is a speculation. As a speculation trade, I don't want to get too far out of the money that I don't think the underlying can reach the strike that I'm buying, right? I want it to reach that and go beyond it. So I'm focusing more on the total from where the underlying is currently at, basically to where on the downside I need it to get to, and what that percentage is, and does the options marketplace think it can get to that percentage by that expiration date. So on these out of the money spreads, I'm not focusing as much on delta. I'm looking at the actual percentage move that I'm anticipating before that expiration date in general. In 30 seconds, I guess. I could go in more detail, but I think we're going to have to wrap it up, Callie.
I think so. Yeah, that was good, Brian. All right. So yeah, we'll go ahead and wrap it up. Don't forget, Brian always closes the loop on this trade and other trades on Fridays at 12 p.m. on Stock Play of the Day Overtime. So check that out. Let's see how we did. Yeah, and thank you for joining us. Brian, you want to take us out?
Yeah, and I want to highlight, I'm going to ask Eric to actually show my screen here for one last time. I do have the actual registration page up for the digital conference, which is going to be kicking off tomorrow, early morning Eastern time. So you make sure you register and you'll get all those reminders. And for the stock play of the day, you want to make sure you click subscribe and ring the bell. And we'll see you this Friday on the stock play of the day overtime edition. Thanks for coming, everyone.